Benjamin Graham. Timeless Principles of Intelligent Investing. Benjamin Graham, often called the father of value investing, was not only a brilliant financial mind, but also a mentor whose teachings have shaped generations of investors, including Warren Buffett himself. His philosophy was simple yet profound. The market may be irrational in the short term, but value always shines through in the long term. Graham believed that investing was not gambling, nor was it simply buying stocks that were rising in price. Instead, it was the art of purchasing a piece of a business at a price lower than its true worth. In other words, buying with a margin of safety. He was born in 1894, a time when financial markets were still developing, and lived through some of the most turbulent economic periods in history, including the Great Depression. These experiences taught him caution, discipline, and the importance of risk management. The margin of safety. Perhaps Graham's most famous concept, the margin of safety, is the difference between a stock's market price and its intrinsic value. By buying well below intrinsic value, investors give themselves a buffer against errors in judgment or unexpected events. Graham argued that no matter how skilled or experienced an investor is, they will never be right 100% of the time. The margin of safety is not about predicting the future perfectly, but about building a protective shield. It's the ultimate risk management tool. The market as Mr. Market. One of Graham's most memorable metaphors is Mr. Market. He imagined the stock market as a moody business partner who shows up every day offering to buy your share of the business or sell you his. Some days, Mr. Market is euphoric, offering to buy your shares at an unreasonably high price. Other days, he's depressed, offering them at a bargain. The intelligent investor's job is not to follow Mr. Market's emotions, but to take advantage of them. If he offers a good deal, accept it. If not, ignore him. The key is to remain independent in thought, driven by analysis rather than crowd psychology. Investing versus speculating. Graham drew a clear line between investing and speculating. Investing is based on thorough analysis, promises safety of principal, and offers a satisfactory return. Speculating is about betting on price movements, often driven by emotion or guesswork. While Graham didn't completely dismiss speculation, he warned that speculators should acknowledge they are taking on higher risk and never confuse it with investing. The defensive and enterprising investor. In The Intelligent Investor, Graham divided investors into two categories. 1. The defensive investor focuses on safety and steady returns, often through diversified index funds or high-quality bonds. 2. The enterprising investor, willing to put in the time and effort to research undervalued opportunities, willing to take on more risk for higher potential rewards. His message was that either approach can succeed as long as it matches the investor's temperament, goals, and abilities. Lessons for modern investors. Even in today's fast-paced, tech-driven markets, Graham's lessons remain incredibly relevant. Stick to a disciplined investment process. Ignore short-term noise. Value companies based on fundamentals, not hype. Always insist on a margin of safety. Investors who followed these principles have survived market crashes, bubbles, and recessions, and often emerge stronger. Legacy and influence. Benjamin Graham passed away in 1976, but his legacy continues. His students, including Warren Buffett, Irving Kahn, and Walter Schloss, have gone on to achieve extraordinary success by applying his teachings. Buffett once said, "The best investment you can make is in yourself, and the best way to start is by reading Ben Graham's work." Whether you're a beginner or a seasoned investor, Graham's principles offer a timeless roadmap for navigating the uncertainties of the market. Final thought. In a world obsessed with quick gains and hot tips, Benjamin Graham's voice still urges patience, discipline, and independent thinking. His philosophy teaches us that wealth isn't built overnight. It's built by making rational decisions, protecting your capital, and letting time and compounding do their work. As Graham might remind us, price is what you pay, Value is what you get.